Good morning and welcome to this Monday, November 22nd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it's Thanksgiving week here in the U.S., so it's going to be a lighter week. We have a holiday on Thursday, half a session on Friday. Earnings season still... There's still a lot of earnings reports out there, but it is definitely coming more and more to a halt. But the next couple of days, today and tomorrow, we do have quite a few earnings reports coming in, especially in the retail area. So keep an eye out for that. Looking at futures this morning as we open up this week, got green, mostly green. We got Dow Jones futures currently up just about 80 points. This was as of maybe 5-10 minutes ago. But the Dow up almost 80, S&P 500 up 12 3/4. The NASDAQ futures up 64. So on a relative basis, we're seeing NASDAQ outperform. And that's despite about a 5 basis point boost so far this morning in the 10-year Treasury yield. Normally, when we see the yield moving up like that, futures on the NASDAQ aren't quite the same, aren't quite as good as the Dow and the S&P. But that's not the case this morning. Oil futures, crude oil prices, $76 a barrel. That is up slightly. We closed last week just below $76. That was a big drop from recent highs that we've seen. Of course, energy stocks have not been performing very well. We'll talk about those in just a bit. But yeah, I mean, overall, I think the market has done pretty well, especially last week. I was very cautious going in. We had options expiring, negative divergences. Volatility had spiked while the S&P 500 was going higher. That's normally a sign we want to be careful of. But it's also a secular bull market that we're in. And sometimes these secular bull markets just shake off everything. And that's what we're doing right now, especially with futures up again this morning. So we'll see what happens. But at least it appears we're going to get off to a good start this week. And I wouldn't bet against this secular bull market, especially longer term. Short term, anything can happen, but long term, I think the market is set up to go a little bit higher. All right, for those of you who are new to Earnings Beats, let me go ahead and bring you over to Earnings Beats, our website. Just want to point a couple things out. You can always try us out for 30 days, no cost. Simply click on that no cost trial button right there, get things going. We also have our fall special running. It runs until this Saturday. So you've only got 5 more days to go. And it's at midnight this Saturday. If you click on that fall special, one of the things our members asked us for in the past, which we delivered this time, was we gave you options to extend and gave you some really nice bonuses if you wanted to extend. So normally our fall and spring specials, we do 1 year and you get 2 bonus months. But this was the best deal we've had to date. We're now offering 2 years. You get 6 bonus months, or the best deal is 3 years. You get a full year for free, and you can see that the monthly cost goes down accordingly. So, and by the way, these monthly charges here are versus our normal current rate, monthly rate of $147. So you can save a lot of money during this special. Make sure you check that out. Scrolling down even further, if you are brand new to Earnings Beats, you want to see what we're all about, I would suggest taking us up on our free newsletter. All it takes is a name and an email address, no credit card. You can unsubscribe at any time. I publish a report 3 days a week, Mondays, Wednesdays, and Fridays, normally out in the mornings before the market opens, usually 8:20, 8:30, something like that. A little bit later this morning that it went out, but normally around 8:30 it's out by. So you can check that out. But I talk about earnings, I talk about relative strength, I talk about gaps, I talk about candlesticks. Just the things that really matter to us at Earnings Beats. So you can check that out right here simply by typing in your name and email address. We'd love to have you. Also, we just started a new quarter in our portfolios. So every 90 days, we select 10 equal weighted stocks to go into 4 different portfolios. And if you click on this, you'll get a sense of how we've performed both since inception and since or during the current quarter. Now, this quarter literally just ended on Friday, so this will be changing as we move forward. We do not do these on a calendar quarter. We do them quarter, because that's when earnings season tends to come to a close. So we kind of wait until most of the earnings reports are in. We've had a chance to evaluate not only their earnings, but also the market's reaction to those earnings. And then we can put together these portfolios. So we did that last week. And so we are in our new portfolios as of Friday's close. But if you check out each of these portfolios, you can look at the since inception dates. There's the model versus the S&P 500. It's more than tripled the S&P 500 in just 3 years. The aggressive is more than doubled. Strong AD is up, I don't know, probably about 33% higher than the S&P, 61% on the S&P, 81% since inception. The only one that's underperformed is the income portfolio. And it's really hard to outperform with the income portfolio right now, because income portfolio more, if you're looking for income, you're going to be putting more value-oriented stocks into that portfolio. And right now, growth is leading. Growth just broke out again versus value-oriented stocks. So you're just facing a little bit more of an uphill climb in the income portfolio, because you are, again, looking at more income-oriented stocks rather than growth-oriented. All right, let's see what else we've got here today. Let's go ahead and move on to the action from last Friday. So we finished last week, the Dow Jones Industrial Average finished down 269 points, failed to hold on to its 20-day EMA. That's noteworthy, but it was really confined mostly to the Dow and also the smaller mid-cap stocks, which I'll show you in just a second. But the S&P 500 and the NASDAQ, which are fueled a lot by those big, large cap names like Apple and Microsoft and NVIDIA, just continued to push higher. In fact, the NASDAQ, you can see, set an all-time high on Friday. That intraday move was up, I believe, over 16,100 before settling back down a little bit. But overall, the action here really, really strong. S&P 500 finished down 6 on Friday, but still within this uptrend, still well above its 20-day, which is above its 50-day. NASDAQ did finish up 64 points, so that was your leader on Friday, and continues to do very well, even though we have seen interest rates bounce back up a little bit. Mid cap, small caps definitely took a hit last week. Small caps down more than 1% on Friday, closing back below the 20-day. I'd like to see small caps hold this 1390 to 1400 level on any pullback, any further pullback. Technology led on a sector basis, up almost 0.75%. Again, benefiting from those names like Apple, Microsoft, NVIDIA, and so forth. Utilities also did well, up more than 0.5%. Just been going sideways really in the 66 to 68 range for the last month or so, waiting to see which way it breaks. I suspect we'll probably break to the upside, maybe go up and challenge that 69 level. Discretionary stocks, which were on fire throughout most of October and into early November, took a little period of profit taking down to the 20-day, and now they're coming back again, trying to break out again. Solid day for discretionary on Friday, up about 0.4%. The worst performing area in the market right now, clearly in the short term, is energy. Energy down another 4%. Mentioned the fact that crude oil prices were up well above $80 a barrel. Now they had closed last week at 75 and change, and they're around $76 right now per barrel. So energy, and you could see it on the chart, I think, as we were struggling to get through the recent highs, that PPO had rolled over and started to move lower. And now we've got price action following suit. I've been talking about this. I'm nervous about energy. I'm nervous about materials on a relative basis, simply because the dollar has been on a roll. And I'll show you that chart in just a minute. Financials, though, also on Friday were weak, down more than 1%. And we're getting some help with the treasury yields. Treasury yields, as I mentioned today, up 5 basis points. So I would expect to see financials turn back up again. But if you look at this triple top, just under $39, and then we broke out, we're right back down to that 39 level, right at the 50-day moving average. This is an area where we need to see the financials turn back to the upside. All right, moving on to the 10-year treasury yield and the bond market. We do have one economic report due out later this morning, I think at 10 a.m. That is the existing home sales for October. The estimate there is 6.2 million units. September was 6 million or 6.29 million. So we're looking just for a little drop off. shouldn't really have much of an impact if we're anywhere close to that estimate, but that'll be out again at 10 a.m. this morning. We'll see. That could have a little bit of an impact in the bond market. But right now, if I give you an update here, you can see that yield is up 5 basis points to 1.58%, bouncing off the 50-day. And it's like I mentioned, I'm a little surprised that financials, look at the relative strength on financials. Now, we did have the big pullback, but then we also had a pretty big jump, and we're just sideways consolidating. Yet the financials on a relative basis really struggling. Don't really know exactly what that's all about. Financials tend to go along with the S&P 500 over long periods of time, but in the short term, we generally see the financials do well when yields are rising, and not so well on a relative basis when yields are declining. So not really, a whole lot of movement back to the upside in the relative strength of financials. We'll see whether or not today's move sends money rotating back toward the financials. Industrials also had a move to the upside. They're coming back down near their recent lows. This one's a little bit of a surprise. I'd watch the XLI because I think 105, that area, 105, 105 and a half on the XLI, I'd really like to see that hold. And if I just pull that up briefly, you'll see we were 105.73. There's the 20-day. But this area, right about where we are is the area where we broke out from. And we've pulled back, which is fine. But I just don't want to go down a whole lot further than this. I think, right in here, these tops were around 105. So maybe you give it the 105 level. Not going to be impressed with a pullback all the way to the 50-day after just breaking out. Normally, we should hold that 20-day. So that will be another area that I would be watching as we kick off this new week. All right, speaking of kicking off the new week and the S&P 500, we're right up at key resistance for all-time highs. I mean, we keep threatening to go through this 4,700 level, but we're struggling to close above 4,700. We do have a negative divergence, so any close above 4,700 will come with a negative divergence in play. These don't always play out, but we do have a stretched PPO here at 1.5. That's about where we were back in April when we got up just a little bit above 1.5. And notice we have a very similar pattern here where we pull back a little, try to get through this area with the PPO rolling over. That's exactly what we're looking at right now. And this ended with at least a 3-day sell-off back to that 50-day moving average. Now, 4,500, would it be horrible if the market were to pull back to 4,500 or close to it? No, wouldn't feel very good in the short term, but it wouldn't be awful from a technical perspective. I mean, if you connect these lows coming across here, I think 4,500 is fine. We broke out above the September high, which was just about 4,530. So anything back down in that range, I think would be fine technically, and especially with that negative divergence. But it would have to occur during the very strong seasonal period, the fourth quarter, where we tend to see the market do really well. So I don't know, which way it's going to go. I do feel like long-term, we are in a secular bull market. If I err, I still want to err for the most part on being, well, not for the most part. I want to err being on the long side. I don't want to err being on the short side, trying to call a top in the market. Last week when I talked about the market being, being a little bit more cautious, needing to kind of see, a little bit more of the action because of the volatility that was higher and because of the negative divergence, because of options expiration last Friday, all of those things. For me, it's about just raising more cash. It's not about becoming bearish and going short, because the worst feeling for me, I know as a trader, for me, the worst thing is being short in a market that I believe is going to go higher, and it goes higher, and I'm losing money on the short side. That to me is the worst feeling. So I tend, when I get cautious, just to sit out a little bit more. I don't have as much at risk in the market. And then I wait and let things settle down. Now, we've gotten past a couple of things from last week, couple of the negative, number one, options expired on Friday. We could still have a little fallout this week. And one question I always get relating to that is, why would it, move into the next week? And it would move into the next week because if you're buying calls last week and market makers are on the other side of those calls, they're selling the calls. If you exercise that option on Friday and you buy the stock, market makers are shorting the stock. So they still have incentive for prices to come down early the following week. So we'll see what happens. But I can tell you, as you start to get into the holidays, the stock market tends to do well. That's historically, that's not just this year. It's not just during the secular bull market that we've enjoyed the last several years. We're talking about most years since 1950. Once we get into the holiday season, we tend to start doing much better, on a both an absolute and relative basis. And when I say relative, I'm talking about performance in other countries. The U.S. tends to do really well on a relative basis throughout these holidays. All right, let's keep moving. I did want to show you the XLE chart. So this is energy. This is a weekly chart. So the daily chart you saw at the open, we were breaking down below the 50-day moving average. So I thought I'd bring up a longer term chart. And I'd be watching that rising 20-week EMA, which is 53.23. That gives us another couple percent, 2-3% to the downside. But I don't want to go all the way back down here to the 45. I certainly wouldn't want to be holding energy stocks all the way back down to that level. So you're going to want to be careful there. If it does break that 20-week moving average, you want to be a little careful. But the areas, when we talked about the draft last week, where we put our 10 equal weighted stocks in each of our portfolios, it's a process that I go through. I just don't look for 10 stocks and okay, here they are and put it. It's really a process. And I described that process last week during the webinar. So if you haven't seen that, you can check out the recording. If you're not a member, you can take out a 30-day free trial and then just go back and look at the recording. But one of the things I do is I start by looking at the various sectors and industry groups relative to the S&P 500. Because if you want to beat the S&P 500, you need to know where the leadership is. I don't think there's any doubt right now technology is leading again. We got very, very extended both on an absolute and a relative basis back in, maybe the middle part of the summer of 2020. Remember the whole pandemic? Everybody was flocking into technology stocks. Not all technology stocks, but many of them. They did extremely well. Relative to the S&P 500, though, second half of the year and even first half of 2021, you can see we had a little bit more struggle in technology relative to the S&P. Well, that struggle has ended. We are now breaking out again. Technology is good. We want to make sure we have adequate representation, maybe even be overweighting technology as long as that group is leading. Consumer discretionary, look at this, came down, but we made this big move up. I talked about this one back in September. This group breaking out of this bullish relative wedge. Also talking about the relative PPO. Anytime we've gotten down to this -1 level, that's when we tend to see discretionary stocks start to move higher again. You see over here, -1, look at that move. Here from -1, big move there. Here from -1, big move. This isn't just, the consumer discretionary moving up. This is the momentum accelerating, relative momentum. So it is really picking up steam versus the S&P 500. That's when you want to be overweight consumer discretionary. Well, look at what we're doing now. Same thing, coming off this -1 level, making a huge move. So I believe consumer discretionary is an area we want to continue to overweight. Communication services, this one's been moving lower, but it's kind of going through periods like we see the other aggressive groups go through. Here, you can see discretionary not working, discretionary not working, discretionary not working, not working. It's not always going up relative to the S&P 500. In technology, the same way. Here was a big relative dip here. We've had some others back. This was actually back when the secular bull market was starting. But here, went sideways to lower for a year before starting to pull back or, turn back up. So when we look at communication services, just understand that it's going up, but it goes through these periods where it goes down, and we're in one of those right now. Well, the further this goes down on a relative basis, the better these stocks are going to start looking, because during a secular bull market, this group does not typically downtrend on a relative basis for very long. And if you look, we've gotten down to -1 here. We got to -1, a little bit more than -1 here, and we're down to almost -2 right now. So we're getting closer and closer to what I think will probably be a pretty big turn to the upside again in communication services. So I wouldn't give up on them. Now, industrials, I was expecting to turn back to the upside and lead, partly because of this -1 level. Again, tends to be an area where we move higher. Also, we just broke out above that 105 level on industrial. So we just broke out after sideways consolidating for 6 to 8 months. So that's kind of a big deal as well. But so far, we're rolling back over. I'm still not giving up on the industrials. I would expect that we're going to see that group move back higher. Financials pulling back, but as I mentioned earlier, yields up today. If the yields start moving up again, we need to see these financials picking up. Let me just go and show you the energy and materials. The other defensive groups I'm not a big fan of. They tend to downtrend in a secular bull market. Energy and materials, you can see, are rolling back over. I know a lot of folks are really excited about energy because they've done well over the last year. Let me just point out the big picture here, because sometimes we get so caught up in the short term that we kind of lose sight of the big picture. I would be watching this as a relative bottoming head and shoulder pattern. Left shoulder, neckline, head, neckline, right shoulder. And we had looked like we were coming up, maybe going to break out. And instead we've rolled back over again. Don't want to lose this right shoulder down here on a relative basis. So that'll be something to continue to watch. Let's go on and look at the materials. Materials also downtrending long term, even though short term we had this nice run after the pandemic, then we rolled back over again. But the thing we have to keep in mind is the dollar. And I talked about this recently. And for those of you who listen every day, I apologize for going over things again, but we have a lot of new listeners. This is really important. The dollar just made another breakout. And really for the last year, I kept talking about the dollar. I was expecting it to strengthen. Well, we finally hit a bottom back in May and June, and you can see what's going on now. The dollar is strengthening. When the dollar strengthens, that is a problem for energy and materials. Here's the dollar strengthening. We've been going up. This is 2011. We've been going up since 2011. I think unless we lose that 2018 low on the dollar index, which is down at about 88, 88.5, unless we lose that, I would be banking on the dollar going higher. And the problem with that is that when the dollar is going higher, energy and materials lag on a relative basis. When the dollar is going down, like it did at the turn of the century, then you can see we get strength in energy and materials. So you got to pay attention to what's going on in the dollar. And right now we're at about a, 15-month high on the US dollar. And we're turning straight up. So I think you got to be careful here. All right, let's go on. There was a question that came up last week. I addressed it. We're getting more questions. So I just want to, this is more of a question and answer for our Earnings Beats members. But the question is about the bullish trifecta scan. And I talked about this last week, but I want to do it again. I'm going to show you. If you go into your dashboard and just scan down for the scans, as an Earnings Beats member, if you also have a stock charts membership and you're at least an extra at least an extra member. So if you're an extra or pro member, you can download our chart list into your stock charts account. If you have done that, what you can do is go in here, click on a new scan. You can get rid of all these filters because we already have chart lists that have already been filtered. So you don't need to filter again. But all you need to do is go down and grab the 3 chart lists, 3 of the chart lists that we've provided. So one is the strong earnings. So we add that. The second is the strong AD. So we add that. And then the third is the raised guidance, which is right here. And then you add that. Now, the problem with doing this right now is I still have to update that raised guidance. It's been dragging on because I've had other things to do, but I'm going to try to get to that this week. Raised guidance. Once you have these 3, this is like nirvana from a fundamental and a technical perspective, because our strong earnings chart list, for those of you who are not familiar with us, this strong earnings chart list has probably close to 500 companies on there, all of which have beaten Wall Street estimates in their latest quarter as to both revenues and earnings per share. So they can't get on this strong earnings chart list unless they've beaten estimates, both revenue and earnings per share. So that's kind of a fundamental that's a solid fundamental factor to keep in mind. Then we have strong AD, which is looking at the accumulation distribution line, which is purely a technical indicator. So now we've got really strong earnings. And then we've also got what appears to be a strong group of stocks being accumulated on Wall Street. And then the third one is raised guidance. So not only did these companies beat revenue and earnings estimates in the last quarter, but they also raised guidance. And so when you run these chart lists against one another, what it'll do is it'll give us all the stocks that are on all three of these chart lists. And that's what I refer to as our bullish trifecta chart list. It's kind of the best of all worlds. And so I'm going to go ahead and run it. This is not going to be perfect because I can tell you, I don't even know if I've updated all of these chart lists on this stock charts account that I'm using for my shows. I don't remember if I updated them yet or not. So it may not have all the right updated chart list. And also the raised guidance hasn't been updated over the last probably 2 weeks, two and a half weeks, something like that. So it's not going to produce the results exactly right now, but this is all you have to do in your own account, because I'm getting questions asking when I'm going to run this scan again. And I can do it once I update the raised guidance, but I just want you to know you can do it very simply. Just grab the 3 chart lists in your account. Don't try to type this in. This applies only to my account. So your stock charts account is not going to recognize these favorites lists. They're going to be different in your account. So you need to physically go down here and grab the 3 lists out of your account and add them. And then when you get up here, all you do is run the scan and it'll tell you right now, this is 63, but again, these may not, some of these companies will change when I get everything updated on the raised guidance. But I think this is a great list to run because it does give you the best of all worlds. It gives you the fundamental side. It gives you the technical side. These are the companies that meet all of these different requirements and filters. All right, let's move on to the 3 you must see. Actually, let's do a little earnings first. I think we got a couple of companies that reported. So this is Cerence or Cerence. Not quite sure how you pronounce it, but CRNC. And if you look at it, the stock has been beaten up pretty badly relative to its software peers. I mean, you look at it and you say, well, it's been going sideways. It's not really losing money. Well, you are losing money if you're investing in a software stock, and this is the one, because software stocks have been going crazy to the upside. So on a relative basis, it's been weak. And we find out why. I mean, the earnings didn't look bad on the surface, 66 cents versus 55 cents. Stock's down 11% in pre-market today. And if you want, you can just click on the symbol summary, type it in. And there it is, 11.5% it's down. So it's going to, right now it looks to open around $92, which will be way down here. So the downtrend continues. One stock that looks pretty good that reported this morning is Avaya, AVYA, up 11%. But this is another one that's been downtrending. I wouldn't be impressed unless we get through about 21.5. So we got some work to do still there. NIU reported this morning, they missed estimates, 20 cents versus 24 cents. Stock down 8.5%. It also has been downtrending. And if we click on that chart, go to a relative chart, you can see it's in a strong group, autos, but look at the relative strength. Very, very weak. So it's in a great group, but it's not doing well. And they missed their earnings expectations, and the stock down another 6% pre-market. All right, let me wrap up with the 3 you must see. We do have Schlumberger. I'm going to go over a few energy names here. So we got Schlumberger. Of course, we said energy rolling over. Well, here you can see Schlumberger, big volume on Friday, also rolling over, losing its 50-day moving average. Right now, I just think it's consolidating, but it's a stock that I wouldn't be interested in based on how energy is performing right now. OXY rolling over, lost its 50-day moving average. Look for a little gap support, price support down around 28. If that doesn't hold, I'd be careful there. And then the last one is SWN, which is Southwestern Energy. This is a gap support area. It's coming down. It looks like it's testing this area. I'd be concerned if it loses about 455, 460. So watch for that to the downside. Overall, though, this one does continue to put in higher highs and higher lows. I would just start to lose a little confidence if it fell much below 455. So watch that. All right, market just opened. Let me give you a quick update on what's going on there. We've got the NASDAQ up 63, S&P up 1920 almost, and the Dow Jones up 111. So overall, I think market looking pretty good to open the week. Not sure we got the latest here. No, I don't think this is the latest. This is probably from last week. So we still got to wait for that update. But overall, we are off to a good start. So the market looks to be in pretty good shape as we start off this Thanksgiving week. As far as our schedule goes, we won't be doing anything on Friday, probably. Definitely, obviously not on Thursday, Thanksgiving Day holiday. Probably going to just take Friday off. It's a very quiet day. Closes early at 1 o'clock. I might send out something, daily market report, a little abbreviated one on Friday morning if I can, but I wouldn't be expecting anything then. I will send out the EB weekly portfolio report on Sunday, but otherwise it'll be a pretty light week for us here at Earnings Beats. Do want to mention though that we are still running that fall special, so please make sure you check that out if you are a member, especially if you're a monthly member and you've been with us for a while. You're going to save a lot of money going to our annual specials that we offer. And then if you're a non-member, this is a great time to try our service, because not only will you get the 30 days, even if you decide in a week to take us up on this special, we'll tack on whatever you do to the 30 days. So you don't lose the rest of your trial. So anyhow, check all that out. Love to have you. Meantime, everybody have a great rest of your day, and happy trading.